You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time, once again, for Volatility Views, the program here on the old Options Insider Radio Network, where we break down all things volatility related. Some may call it the premier program for volatility trading. So VIX Options, VIX Futures, volatility ETPs, and all the nuances therein, OTC, variance swaps, all sorts of fun. Anything that touches on the world of volatility. Chances are we touch on it here on this program. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-expanding Options Insider Radio Network. 15 programs for you guys to choose from on said network, including about hundreds of archived episodes of Volatility Views. I encourage you, if you're new to the program, go check it out. We've had some great guests, Nobel laureates, academics, researchers, practitioners, fund managers. The list goes on and on in terms of who's joined us here on Volatility Views. We're going to add to that guest roster in a little bit, but before we do that, let me welcome on my cohort, my partner in crime, the senior instructor over there at the CBOE Options Institute, Mr. Corner Office, Mr. Russell Rhodes. Russell, welcome back to the Volatility Views program.
I am, as always, thrilled to be here, and I apologize for not making it last week. And of course, it's like the next time that I cancel on you at the last second, for goodness sakes, get long volatility.
Yeah, that seemed to work out this past week, and we'll get to that in a little bit. We'll also be joined in a little while by Mr. Sebastian, who probably is caught up in all the madness. We are recording this, of course, and streaming it live here on Friday, November 4th, for all of you playing along. And a little bit of craziness going on here in Chicago, if you're not aware, listeners. About a million or so people descending on Grant Park, a few blocks here from the studio, to celebrate all things Cubs. But the show keeps rolling, and we're going to keep on rolling with a great guest. So let's get to it, right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to the Volatility Viewpoint. This is the portion of the program we welcome on guests from throughout the world of volatility and proceed to pick their brains for the benefit of you, the listener. And today's guest he's been on the network before, but this is a first timer on this program. He is David Hait, the CEO of OptionMetrics. David, welcome to the Volatility Views program.
Hi, Mark. Thank you. Thanks for having me.
And David, since this is not really your first time on the network, but it has been some time. It was back in June of last year where we had you on our Options Insider radio program. So it has been a little while. Why don't you go ahead and give our listeners a really quick overview of your background in the space and what it is you guys do over there at OptionMetrics.
Sure, Mark. OptionMetrics is a provider of quality option price data tools and analytics. We primarily sell to the institutional marketplace. We have over 300 institutional subscribers for our data sets, which include long history of option prices, implied volatilities, and Greeks from exchanges in the U.S., Europe, and Asia. It's a good tool for researchers, quantitative investors, and we also have quite a few customers who are academics at universities who use our data for fundamental research in the options markets.
Let's get into some of that data and some of that research now. It's one of the reasons we wanted to have you on the program. We touched on it a few weeks ago. We wanted to get you to come on to actually speak to the research yourself. You guys released an interesting white paper recently on VIX and some of the nuances therein, including some of the issues with the variation that you guys determined. Like I said, we discussed it a little bit last week, kind of get a bit of a cursory overview in our volatility review segment, but I want to do a deeper dive here. Why don't you go ahead and give our listeners an overview of the paper, what your goals were, what you were looking for with this white paper, and maybe some of the interesting interesting findings that may have surprised you as you unearthed and did the research for this paper.
Well, I would definitely call them surprisings as well.
I like it. We coined a new term here, the surprisings of volatility.
We took a look at VIX. VIX has been getting an increasing exposure in the press. People seem to be talking about the VIX every day these days, especially with the elections coming up. And one of the things that we have noticed about VIX for a very long time, and we're not the only ones who've noticed this, is that it seems to move in the opposite direction to the S&P 500 index. When the market goes up, VIX tends to go down and vice versa. We've also noticed, and again, we're not alone in this, that the VIX has what we in statistics call a strong autocorrelation. It means that the value of the VIX on any given day, it relates very much to its value on the previous day. Now, this is something that happens in finance all the time. We find that volatility tends to cluster. So if volatility is big on one day, it's likely to be big on the next day. And that might explain why the VIX has these persistences to it. A large VIX one day often means you'll have a large VIX the next day. We wanted to look into that relationship a little bit more closely. So we ran some statistical tests that basically asked the question, if you have information on today's markets, including changes in the SPX, changes in the VIX itself from its previous day, how much of what we already know can tell us what the VIX is going to do at the end of today? The technique we use for that is simply what statisticians all over the world use. We use the linear regression. This is a standard statistical technique where we compare the value of the VIX today with the value of the SPX returns today and the VIX yesterday and on previous days. And the results actually were very interesting. We found that an incredibly surprising amount of the daily variation of the VIX can be explained by information which is already in the market at the same time. Changes in the SPX, for example, yesterday's value of the VIX. The conclusion to this is that if you can explain most of the VIX's value by what's happening today, then how much of the VIX's value is left over to explain what's going to happen in the future or to predict what's going to happen in the future? And the answer is it's a very small amount. It's about 2%.
That's kind of interesting that you would mention that, because you're right. A lot of a lot of the broad media as they've embraced VIX, and a lot of them have done quite a bit. It's been around this notion of the VIX as the fear gauge, and it's a very catchy moniker. I could see why a lot of the media has kind of taken that and run with it. You turn on CNBC now on any given day, you're going to see a couple of quotes. You're going to see the S&P, probably the Dow, maybe crude in there, maybe the dollar, and of course the VIX. It's always up there. It's kind of in the conversation now. Even the general investing populace seems to be aware of this notion of the fair gauge. So it's kind of gathered this reputation of this being this prognosticator of future fear and indeed sentiment in the marketplace. And it sounds like, at least according to your research, you're saying that's not entirely the case, David.
I have a colleague who says it's like after there's a fire in your neighborhood, everybody runs out and buys fire insurance. So we think there may be a similar effect going on here, where on a day when the SPX drops, the VIX goes up. And that doesn't necessarily tell you that everybody thinks that tomorrow's volatility is going to be higher. It's that kind of relationship that's being captured. If you did not have a VIX, you could simply look at SPX returns over the last 2 weeks or so and get the same kind of information that the VIX is currently giving you. Now, again, when I say the same kind of information, we're talking to about a level of 98% of the variability of the VIX. There's still about this 2% left over, which might have a predictive component. I think that the point we're making is that when the popular press says, well, the VIX went from 18% to 19%, therefore markets are more jittery than they were before, that's not necessarily a great conclusion.
There's a lot to read into that there too, because that about 2% that you allude to, and not even to 1.2% of the variation. We get a different theme on that question a lot to this show, which is how much you mentioned S&P vol being a better predictor, or a good predictor at least. People always ask us, well, what is the VIX really versus it's supposed to be S&P vol, but it has this formula, and of course VIX is a tradable product, so that's going to inject some sort of different nuance into the product itself, because people are buying, selling in VIX independently of what's going on in the SPX products. That's going to have its own kind of flavor. And people are always asking us, does the VIX wag the dog or the S&P? Does one lead the other? Is the VIX going to move things? It sounds like you're saying, maybe from your research, if we can quantify a little bit farther, are you saying too that maybe have we finally quantified what that tradable impact of the VIX is? Is it essentially that 1.2%? You think that's where that extra flavor, that layer, that nuance of VIX from your research is coming from, the tradable component of VIX?
That seems to be implied by these results, yes, that's the piece of it that is either based on market sentiment or it's pure noise. And we couldn't tell you how much of it is market sentiment and how much of it is pure noise. I do want to point out also that something you just said about the VIX being tradable, it's actually the VIX futures which are tradable. The index itself is not, and that's a critical difference. The futures market does tend to follow the calculation of the index itself, but of course there's additional information there, right? The futures market has a skew to it. There's a term structure, and that's where the important information is. I think you might be better served if you're trying to figure out where volatility is going over the future. It probably makes a lot more sense to look at that term structure of the futures rather than the index level itself.
Yeah, we had an episode we did a few weeks ago, and the title of the episode was "The Answer to All Volatility Questions is the VIX Futures Term Structure," and I think you hit on it again right there. At the end of the day, you're right. The tradable instruments are where the actual market sentiment, the future interest is being played out, and where the money is actually being put to work versus the cash, which, as we said many times on this program, is kind of, in and of itself, kind of just this abstract number that is thrown out. You throw out a VIX cash of 14 or 20 or 13. What does that mean? Independent of the context, which is, of course, the VIX futures, which is, of course, where the S&P is, the skew, all these other things that have to go into that number to make it more resonant and actually have some actual meaning. But I do like your 1.2% number, David. I'm going to borrow that, if you don't mind, going forward. So when everyone writes in, and they always do like clockwork, with how much of the VIX is its own beast, independent of the SPX, I'm going to now turn to them and say it's exactly 1.2%. So if nothing else, we've accomplished that today, David. So I appreciate that. You've given me an answer to all those emails. Actually, I'm just going to forward them to you going forward, if you don't mind, and you can give them.
We'll just have hats made up that have 1.2% right on the front of them.
1.2%. But obviously, for a lot of our listeners who are hearing this maybe for the first time, haven't had a chance to crunch the numbers, to look and digest the actual full white paper, we'll include a link to the full white paper in the show notes, listeners, so you guys can digest it all for yourself and go through the methodology of it. But what would you say, David? Obviously, this is an interesting kind of development. What would you say would kind of be a key takeaway for someone who's looking at this for the first time, maybe is only familiar with VIX as kind of this fair gauge notion? Are you effectively saying that maybe using VIX as your prognosticator of future volatility, independent of all these other items that we're talking about, like the term structure of volatility and skew and everything else like that, VIX in and of itself is not perhaps the measure of that, or perhaps isn't measuring what they expect it to?
I think that's right. I think that the takeaway is you should be skeptical, and if there are major changes in the VIX from one day to another, let's see what's causing those changes. Is it really a change in sentiment, or is it just other things that are changing that already contain that sentiment? If somebody tells you the VIX has jumped by 2%, they may as well be telling you that the market dropped down by several points. What we'd really like to look at that VIX number and say, okay, what can we extract out of this that's useful information about the future that we can't get from any other instruments?
And what was it that inspired you to want to take a deep dive into all things VIX? Was it just it is kind of the hot product, the product du jour? So I know if we do a show about VIX, so anything you do VIX usually gets a lot of interest. Was it just that, or were you really thinking that there might be the more layers to this onion as you started to peel it back?
We were just looking at the index to start, but it certainly opens up a lot more questions than we had originally. I'd certainly like to look at that term structure of the futures. I'd like to see what kind of information is that. Can we draw the same conclusions from it? And certainly we'd like to look at the implied volatilities on the single stocks as well and see what they can tell us. I think there's a lot of room here for further research and a lot of great questions that can be asked and hopefully answered with our data.
And Mr. Rhodes, you spend your days knee-deep in all things VIX data over there at the CBOE. One of the reasons I like to have you on the program. I'm sure this white paper is very interesting for you as well. The more VIX data you guys can get your hands on, the more number crunching, the better. What are your thoughts here about this paper, and any questions you may have for David?
Well, he just beat me to the punch. I was going to ask him if he had given some consideration to expanding the study to the relationship between the futures and the spot. The other things, I've actually done a paper for my PhD program that I haven't that we're getting ready to actually submit to a conference where we actually found that the VXV, the 3-month volatility index, is actually is a pretty good predictor of where VIX is going. So, that's another thought that I would throw out there, is maybe taking a look at the 93-day version of VIX relative to VIX and seeing if you get some different results with that.
Yeah, definitely. I think that's an interesting direction as well.
I think there's a couple of ways you can go with that. Obviously, you can go farther out. We've also they've added a little bit more nuance to the VIX calculation recently by incorporating the weeklies. I'm curious, David. Obviously, your research is very recent, so I'm sure it incorporated this weekly impact. But do you think maybe diving deeper in some of the near-term products as well, the weeklies, not just the VIX, but also SPX and everything else like that? I think maybe looking at some of the weekly products will add any more insight into this. Maybe that level of variation will vary, pun intended. Maybe a little bit less or a little bit more. Maybe in the near term, a little bit less farther off. Has there any sort of analysis you've been able to do, or maybe some conclusions you can draw from your data so far? Is that going to vary over time, or you think it's going to be relatively consistent at this 1.2%?
I'm sure it will vary. We have not looked at it, but I know that there's a huge difference in terms of the behavior of the weeklies and the 30-day VIX, and we'd like to take a look at that. I think that 30-day tends to smooth out a lot of future anticipation about the markets. The weeklies would capture more of what people think is going to happen during the next week or the next 5 days, and we'd love to take a look at that. That would be another great direction for this going forward.
A lot of our listeners also like to play not just in the VIX options and the VIX futures, but the legion of VIX ETPs out there. So your VXXs, your UVXYs, and we've talked many times on this program about the pros and indeed many cons of that expanding universe of VIX ETPs. But if they're solely looking at VIX from an ETP perspective. Let's take VXX, for example, one of the more popular of the VIX ETPs out there. If they're coming to us and coming to this as a VXX listener or user, first off, they should know better if they listen to a program like this. But if they come to it through the context, through the lens of the VIX ETPs, what, if anything, should your research really mean for them? What takeaways should they be taking, if anything, from this?
Well, again, the 2% or the 1.2% is interesting. The 98%, I think, is even more interesting. Is if you're worried about a big jump in the SPX, you can hedge it with one of these products, because if the VIX moves to hedge very well these large jumps, then it's a great hedging vehicle. So it's another way to use these instruments, I think, in a good portfolio.
Well, there you go, a check in the plus column for a lot of these VIX ETPs, which, as we all know, have suffered of late for a variety of reasons, and we've maligned them on this show, sometimes fairly, sometimes less so. But names like VXX have a lot of problems associated and inherent to the way the product is constructed. But still, at the end of the day, it sounds like you're saying for that jump risk, which is effectively, at the end of the day, why you're getting into a product like VIX. We've said many times, you're not getting into VIX for a slow volatility creep down from, let's say, VIX cash at 13 down to 11. You're getting into VIX for that pop from 13 up to 25 or 30 or beyond even. That the upside is where VIX really tends to outperform, and a lot of the strategies we've seen unfolding in all things VIX options over the past few years have really been designed to kind of keep that table stakes, keep your seat at the table short 1x2s and things like that, to keep you in the game until you can capture that big movement. And it sounds like, at least from your research here, that VIX can at least do that, the big jumps in SPX. Well, before we move on to some of the other stuff, David, any final thoughts you want to leave with our listeners regarding this paper in particular, as well as, kind of Russell alluded to, any maybe corollaries, any addendums you're going to be doing to build on this in the near future?
We hope to do more papers like this. It got very well received, obviously, and we were very excited about the results. I want to point out that we're not the only ones using our data for research. Our research data is used, as I mentioned, by academics and by quants all around the world. And every year we do a research conference. Our research conference, OptionMetrics Research Conference, is coming up November 14th. The details of the conference are on our website if any of your listeners are interested in taking a look at it. Every year we get a whole bunch of very excellent research papers presented, which explore topics very much like this, about changes in volatility, changes in the VIX, the relationship to the equity markets. Our keynote speaker this year is John Marshall from Goldman Sachs, and we're looking very forward to having it occur on November 14th.
You beat me to the punch there. I was about to get to the research conference next. But David, if they do want to learn more about the conference, or indeed learn more about this white paper or a lot of the other research you guys have done over there at OptionMetrics, or indeed get access to your data, which I know is your core product, where should they go? What should they do?
First stop would be our website, www.optionmetrics.com. We have a description of our products up there, as well as a very extensive research section, which gives a list of all the papers that have been published using our data for the last 15 years. It's a great read. Some of them a little bit more detailed than others, but very exciting stuff.
There you go, optionmetrics.com to learn more. If you want to read more of this white paper, listeners will have the link in our show notes, or you can head on over to optionmetrics.com and check out the white paper for yourself. Well, David, I'm glad we can get you on, because like I said, we touched on this a couple of weeks ago, and I wanted to make sure to get your flavor, your spin on it, because it is indeed your research. So thanks again for doing that. We'll have to bring you back on down the road as you have more interesting volatility research to share with our listeners.
Thank you, Mark. Thanks very much for having me.
All right, and that's it for the Volatility Viewpoint segment. And now we're going to keep on rolling with the program right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the program where we break down all of the interesting things that have been going on in the week that was, and indeed still is, from a volatility trading and analysis perspective. And as you alluded to there, Russell, what a week it was, and indeed has been. You weren't on the show last week. We were all kind of all over the place from a volatility perspective. I won't foreshadow the crystal ball too much, but I don't think it's fair to say none of us anticipated the velocity, indeed the breadth, the speed, and the scope of the move we ended up seeing here in the old VIX cash this week. With VIX cash, as we're doing the show here, right around 21.5. So pretty aggressive one. That's, of course, down from its recent highs, hitting near just a tick, literally a tick under 23, 22.99 yesterday, and coming off on the heels of that, off about 0.7 of a point, off to about 21.5 here today. So crazy stuff here on the old week, and a lot of this, there's a lot of ways we could parse this. Of course, there's the impending election, which is a huge driver of all things volatility. We saw yet another wrinkle emerge in that this week. Well, it started actually last week, literally as our show was going on. We saw the VIX cash jump 2 or 3 handles over the course of that hour as the news broke that the FBI was unveiling, or I should say reopening their investigation to Hillary's email. So that sent the markets into a tailspin, volatility shooting up. And of course, this week, as more investigation notes have been released, we've seen that kind of pile into the market, weighing in, sparking perhaps, or at least exacerbating a sell-off. News that Trump is moving in within the dead heat in some polls. So a lot of things have moved into flux here in this final week, indeed final few days heading into the election. So all of that indeed piling in to volatility and being reflected in the term structure and in the VIX cash out there. So a lot to unpack. It's been an interesting week to watch all things volatility. I'm sure you guys over there at the SIBO have been pretty busy this week, Russell, with a lot of inquiries. What the heck's going on with the VIX? So indeed, sir, what the heck is going on with the VIX, and what caught your eye this week?
VIX is high. It's it's that's my towelly. I mean, everybody's aware of what VIX has been doing and working its way above the 20s. Even with the stock market actually turning green for the first time today, it's still up above 20. There is we could spend the full hour talking about how things changed just in the course of a week. But a couple of things that I think people are losing sight of are the 3 month and the 9 month, or I'm sorry, the 3 month and the 6 month volatility indexes. Those things are above 20 as well, which leads me to believe that the change as far as the risk premiums relative to the equity markets, it's not expecting it to go away after next Tuesday. There's some real concerns with respect to not just the outcome of the election, but the aftermath going into next year.
Yeah, crazy stuff like we just mentioned with David. Some of that farther off vol may be more interesting and maybe a little bit more valuable from a prognostication standpoint out there. We like to talk about VIX. We also like to talk about all things VVIX, the volatility of VIX. As you can imagine, that volatility of VIX is quite high these days. Going into last week, right around showtime or so, it was elevated, but still far lower than it is now. It was in the 80 or so range. Usually you see it settle down back into, it was in the mid-80s, usually in the mid-70s seems to be the near-term somewhat trough, but certainly not as elevated as it is this week. It's spiking as high as about 120 before settling off a little bit today, down about 115. Still extremely elevated. So the volatility of volatility, I know that's a very disconcerting concept to some of you out there, but the volatility of volatility is indeed very high. We're also seeing, again, that nice spike in the cash as the VIX futures are trending around interesting levels out here as well. All things cooking out here in VIX cash. But I know, Russell, before we can get to the futures, the volatility of VIX, aka VVIX, one of your favorite indicators. What are your thoughts of what we've seen playing out there over this past week in VVIX land?
VVIX does a fairly, I mentioned when we were discussing the paper previously that VXV, the 3 month version of VIX, does a good job as a leading indicator of VIX. VVIX does the same. It has, and Mark Sebastian has really been on although he's not on the ball today, but he's really been on the ball as far as noting that VVIX has maintained higher levels even when we've had a drop in VIX. And the drops in VIX, the low levels for VIX this year haven't lasted as long as I think they have in the past. And VVIX up around 120 is just the market bracing for more volatility in the future, for sure. I like how you say VVIX is a little disconcerting. I think we need a volatility index on every market, a chicken in every pot, and a volatility index for every market.
I'm certainly on board with that. I've gone on record many times on this show advocating for more volatility products. I'm still waiting for the single name VIXs to list, the Apples, the Amazons, and whatnot. So I'm firmly in the camp of more volatility products, just selfishly to help me fill my time here on this program, which is always a fun thing. Of course, the VIX cash, I said, right around 21.5, 21.25 right now, ticking off a little bit. The future is also down a little bit to that front month node contract in the 1865 range. If that disparity disconcerts you, we have a listener mail about that a little bit later. We'll get to that. Moving on into the options. It's been a few weeks, Russell, since we've had a chance to hear everyone's favorite tune here on the program. So if you're up for it, if you're ready to dive into the deep end, we will dive right on into Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, sir, what's been catching your eye over this week? And indeed, if you want to delve into last week a little bit too, go for it.
You know, it's kind of nice to hear my intro music and not hear Mark Sebastian laughing in the background.
That is a nice thing.
So, you know, needless to say, everybody's focused on the November 9th VIX futures. And this is a warning. This is like our public service announcement with respect to those futures. Keep in mind, they will be trading the evening of the election, but they do settle at around 8:30 or so based on the S&P 500 option market open on the 9th. And the options, the weekly options, you can put on a trade if you think you have a good idea of what settlement's going to be doing the next day, but you won't have a chance to trade it once those returns start coming in. So I most definitely want to point that out, that we do have a November 9th VIX future, but it does, you don't have a lot of flexibility with respect to trading around it between when we start getting the results and the results come out. We have seen a nice increase in the open interest in those November 9ths, though. I don't know if people have been trying to play some sort of reaction in front of the election, or if they've been maybe fading the reaction that we have had in front of the election. But there's a little bit more interest there. With respect to the weeklies, I am going to deviate to the SPX weeklies, because with the addition of Wednesday and Monday expirations, we have a wonderful piece of data to work with. We have at the money implied volatility, basically using a version of the old VIX calculation that only used 8 options. Our friends at LiveVol use a very similar methodology to give us a standard implied volatility measure for each expiration date. And I had been paying close attention to the November 4th and 7th options that expire before the election, and the November 9th and 11th that expire after. As we speak, midday on Friday, the November 7th, the Monday options, the implied volatility is 1253. Mark, would you like to even guess where the implied volatility is for the November 9th?
I'm going to guess 1542. A good year.
2675.
I was going elevated. I wasn't going that.
I thought you were going to say around 20 or so.
That high into the stratosphere.
It has been at about 60 or 70% premium. That has widened out tremendously in the last couple of days. It's a fun stat that we've never had access to before, because we haven't had so many expirations. But if you're thinking about playing the election, if you think the implied volatility, and I was on a panel earlier this week where there was a sell side guy that was talking about the November 9th options and how high the implied volatility is. regardless of the outcome, if we know the outcome, we'll probably see some sort of a volatility crush with those SPX options that expire on the 9th. If I were, and this is going to sound so sacrilegious coming out of my mouth, but if I were thinking about trading, index options around the election, I would probably think about those November 9ths that expire at the end of the day instead of the VIX options that expire on the open on November 9th. There, I said it.
Heresy, sir. But, it makes a lot of sense. And we've said this before, many times, regardless of what the event risk is, it could be an earnings, a crop report, or in this case, an election. Oftentimes, the better play is to not ride the position through the turbulent waters of the event itself. Put on something ahead of time that could take advantage of some movement, some activity, or as the Rock Louse likes to say, get your juice for free ahead of time by doing that, and then get out while the getting is good. Don't ride the barrel over the falls if you don't have to. And I think you're alluding to a very similar strategy there, Mr. Rhodes.
No, absolutely. I just, we'll see how this thing turns out about this time next week. But it sure those November 9ths and even the November 11ths, which are up around 26 as well, are bracing for something. As I blurt that out and thinking out loud, I wonder if there's a calendar spread opportunity there. I don't know. So I got to get to work.
Indeed. People are, even though you'd think a day like today with all of Chicago massing in Grant Park and just hundreds of thousands, indeed million, probably plus people getting down there wearing a sea of cubby blue, you'd think all of Chicago would be shut down, but apparently the VIX options pit is still rocking and rolling today. Someone out there is trading. The one guy who's there is certainly doing a lot of paper today, because already today, with about this a little bit past halfway through the session, we're closing in. Just ticked over 1 million contracts already today. The ADV right now is about 528,000, so the ADV has been dropping precipitously over the past few weeks. It has been for the better part of this year about 600,000, has been slowly eroding over the past few weeks down to about 528. This week I think we'll bump it back up into a little bit north of that. Like I said, today already 1 million plus contracts, and we're only halfway through the session, so probably looking at 1.3 million, 1.5 million day when all is said and done, perhaps even more. And the rest of the week has also been very, very active. Yesterday, 882,000 contracts. Wednesday, 600,000. Tuesday, 731. So Monday, the only day of the week, again, Halloween, the only day of the week shy of that ADV. It's just about 400,000 contracts going up on Monday. In terms of the narrative this week, we didn't see a lot of really amazing trades that were kind of being our narrative throughput for the week that we like to look at a lot out here. We did see some funky spreads going up, like on Wednesday. Looks like puts, which are always kind of interesting in and of itself. A bit of a funky put tree slash stupid slash tree, kind of a bit of a hybrid. No 14.5, 15, 16. Funky spread, we'll call it, put vertical with a kicker perhaps. Looks like paper buying the no 15s and 16s 19,000 times, and then turning around, blasting out the no 14 halves 19,000 times, doing those for 31 cents, 50 cents, and 89 cents respectively. Also seeing a bit of a aggressive, call it a upside stupid, going up on Wednesday as well. The 25-30 stupid going up, about 15,000 paper selling on the 25s versus about, looks like nearly 20,000, 19.2 on the 30 calls, doing those for 72 cents and 35 cents respectively there on the old day. And it just seems like stupids. I guess if there was a narrative, it was kind of stupids slash funky tree slash funky verticals kind of being the order of the day, with it also a put stupid going up on the Nove 17, 15, 16 also going up. Paper pretty much blasting out all of those 6,700 times for a variety of prices there. And moving on to the hot strikes of the week, what has been the strikes du jour. Once again, this time actually it is all calls. So even though the put stupids were active this week, no puts on the list. Everything kind of getting pushed down a little bit as the volumes are increasing. Some of the anemic volume names we've had on the list in weeks past don't make the cut this week for the top 10, and it's all no with the exception of one Dece on the list. I'll let you guess which strike is the hot D strike. You probably can guess it if you listened to the show before. But number one with a bullet are the Nove 21s, 348,000 contracts open there. Number two, the Nove 20s, 211,000 contracts there. So falling off quite a bit there between number one and number two. Number three, the Nove 18s, 189,000 now. The fairly in the money Nove 18s, 189,000 there. Number four, the Nove 24s, 178, also 178, tied for number 4/5 is the Dece 30 calls. Always on this list, there will be a 30 strike. In this case, they are back to back, 173,000 for the number 6 spot, which are the Nove 30s. So that 30 strike just can't get out of the collective imagination of the VIX trading public. Number 7, the Nove 25s, 169,000. Number 8, 165,000 of the Nove 28s. Number 9, the Nove 23s, 148, and 144 for the number 10 spot, the bottom of our list, the Nove 17 calls. Total of about 6 million outstanding, 4.5 on the calls, and about 1.5 on the puts. I'd imagine, given the paper we're seeing this week, that that number will probably increase next week. Before we move away from VIX options, anything else catching your eye this week in this explosion of volatility and indeed of activity out here in VIX options, Mr. Rhodes?
There's a big somebody is buying the heck out of the 16 strike puts, and there may have been, you and I are using the live vol platform. There which does not include the trading activity before 8:30. I'm hearing from the guys in the pit that there was actually a big put buyer that came in during the extended hours trading as well. I just haven't had time to dig into that, but apparently somebody wanted to get ahead of whatever price action was going on today, which is, we usually don't see very large block trades during the non-U.S. market session.
Yeah, it's usually around, I think, 7 to 9% of the volume goes up in those kind of extended European hours, extended hours type sessions. But you're right, we didn't have a chance to see that big block trade. So that went up, and that in and of itself is worthy of note. A little bit more paper, a little bit more volume accreting to those after hours. Again, perhaps a sign somebody overseas is up to something. Speaking of things that were up to interesting things this week and people who were up to stuff this week, a lot of people out there slinging earnings volatility this week. I know it's one of your favorite times of year, Mr. Corner Office. It is earnings season. We're seeing a lot on the vol front this week. Some big names coming off this week, including Alibaba. They posted before the bell on Wednesday. They were closed right around 101 or so on that name. They were pricing in about a $5.50 move, so a little over 5% they were pricing in. And what do we see? We saw it open up about $2.65 or so and get up to nearly up about $3, but underperforming net on that straddle, only up about $3 net on that day. So premium buyers had to hold out a little bit to see if that could indeed come to pass. Facebook, the much ballyhooed Facebook, disappointing on the downside. They were closing right around 127 going into their announcement. They were pricing in about $6.70 or so on that straddle. They opened up down about $5, a little over $5, but as the day progressed, they traded down about $7.50. So they outperformed to the downside. Again, that came into our poll, which we'll mention in a little bit as well. That factored in there as well. So Facebook, at least for the premium buyers, getting some opportunities. And a lot of these names too, you had some chances intraday if you were adept. So even if if you're premium buyers and you held out, you did all right. In the case of Baba, if you were patient and you're a premium seller, you did all right as well. And also premium sellers, looks like they're winning the day out here in Starbucks as well. Starbucks went out $52. They were pricing in about a $2.50 straddle, so nearly 5%. And today, as we speak, the name's up about $1.20 or so, so a little over 2%. So premium sellers winning the battle out there this week as well. Anything catching your eye this week on the earnings volatility front, Mr. Rhodes?
There really wasn't. It's not so much this past week as it has been. I think we're about to get through the third earnings season, where if you're out there putting on a bunch of iron condors, you've done extremely well, because we just aren't seeing the outlier moves. Whenever I look at you mentioned a couple outlier moves, but the majority of the moves have not been all that extreme. And I don't know if the information flow has become better or, or if we're just in such a calm period of the economy, kind of a stagnant period of the economy where you're not seeing any huge upside or downside surprises. But I just want to, it's all about public service announcements today. The next one is be cautious about, selling volatility in front of earnings. We're going to have another one of those earnings seasons where things go nuts. They do come around. And also remember that companies have a little bit more stringent rules with respect to earnings when they announce their annual numbers, and that's the next earnings season. So be careful out there.
Be careful out there. Before we move on from the vol review, Mr. Rose, I just want to get your thoughts on this. We had Bill Luby on last week. We also had Andrew and Sebastian, the Greasy Meatball, all kind of pinch hitting on the show last week. So we had kind of a cavalcade of craziness on the show last week. But I tossed out to them this new index you guys just launched over there at the CBOE, the Smile Index, which is indeed attempting to try to replicate trading the curve out there. We know you guys already have the skew index itself. This is more of an active management type strategy, as we kind of outlined last week. It's going to swing between a strangle and a bullish risk reversal depending on the slope of the skew. I'm going to do that. The barometer for when it flips is on the put call ratio, which is kind of an interesting mechanic to hang your hat on for when you decide to go from a strangle to a bullish risk reversal. And I tossed this out to the panel, Russell, for their thoughts on this index, and I got pretty much crickets. No one knew anything about it. No one could say anything about it. So this is why I was happy when you were back on the show this week, because I'm sure you've been following this. Why don't you give our listeners your thoughts on this index, the utility of it, or the use case for it, maybe, and also your thoughts on that demarcation there where they're pulling the trigger with the put-call ratio, which is kind of interesting. I don't think I've ever seen an active management strategy designed to flip around that before.
I think the overarching idea here is more of, you're talking about the put-call ratio part of it, but it's more about the flatter the smile or the more steep the smile. That's really where the trading decision is coming from, and I think it's absolutely wonderful that we've had what you could call smart beta indexes with the buy right and the put right, which consistently do the same thing every month. But I like when we include especially something that's based on the shape of the skew or any other type of implied volatility indicator to make an actual trading decision. And this is a very basic it's a very basic trading decision. In fact, this was previewed at RMC Europe. Before it was announced, it was actually discussed. And when Bill Speth was talking about, the indexes that we create, he said one of the rules of thumb is that it has to be simple. And this is pretty simple. You just, based on where the, what the skew is looking like, you put on different positions, and the positions have actually worked particularly well. It's had basically lower returns in a bull cycle, but much higher returns in a bear cycle. And has the Smile Index, we've got data going back all the way to 1986. And this thing has knocked the cover off the ball relative to the S&P 500 total return, just holding that. And it also has knocked the cover off the ball compared to more neutral type of strategies like consistently putting on an iron condor or an iron butterfly. I've seen other indicator-based systematic approaches to doing iron condors where you don't do them in certain market environments. Typically, you kind of avoid them when we are in a dramatic drawdown, and which has improved the returns there. It's the same sort of philosophy here with the Smile Index, where you're putting on a little bit different neutral type position based on what the option market's telling you that you ought to do. So Is that better than crickets?
A little bit better than crickets, yeah. They were all completely overwhelmed by the concept of this index. But yeah, it's kind of funny. I was thinking about it when I first saw it. I was like, oh, put call ratio. That's a weird way to do it, But then I started thinking about, like, kind of like you were saying. I started thinking about the target market for this, which is the asset managers, the advisors out there, the fund managers, who, as we know from, as I know certainly from doing the Advisors Options show, you kind of have to approach them. You have to tread gently when you go into the deep option waters with them. If you go out to them with a skew index that's going to flip from a risk reversal to a strangle based on, let's say, the relative discrepancy of the implied volatility of the 25 delta put versus the 25 delta call, when that hits a certain change in percentage, that's when you flip. You start getting it, which is probably the way I would construct something like this. If you do something like that, I could just see the marketing challenge and the eyes glazing over of any advisor and asset manager who's listening to that. It's already an obtuse concept. You go that deep down the rabbit hole, they're not going to embrace it at all. So at least something like put call ratio, they can wrap their heads around that. They understand that. They probably have heard of that before, even if they don't know anything about options. So I could certainly see the logistical and just the marketing benefit of going that approach, I think. So I'm curious about this one. I know this is just an index for now. There are no products for it, but I think the plan is to have some things benchmarked to this, and it'll be interesting to see how this goes going forward. I know BXM and PutRight certainly have their audiences, and this is kind of a new flavor, a new wrinkle they're in. So I'm looking forward to watching this one. Meanwhile, it's time for us to keep on rolling. We got time really quickly for a quick volatility voicemail. So let's do that.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the OptionsInsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, before we dive into that really quickly, we should even amend what we were just talking about, because I was saying I like to see it a certain way with that smile index. You're saying, Russell, actually the press release doesn't do it justice to convey the actual nuance. So why don't you go ahead really quickly and convey exactly, because the way I described it, which is kind of the way I thought was a little odd, which was just doing the volume of the put call, you're saying that's not exactly how they're doing it.
No. It's and I was trying to be polite. I was like trying to steer you toward the implied volatility. It's a ratio of the implied volatility differences between the put and the call.
Oh, that's
it is a put call ratio, but
like
it's
that
not
much
the
better.
volume one that most people are thinking about. And then the thing that I was we started to move on, but I did want to add, there's been so much goofy stuff going on with the election that I kind of put talking about the smile index on the back burner until after the election, but I'm going to make a big social media push about that in the next couple of weeks. There's just been so many other things going on.
Yeah, there have been a few things going on in the world of volatility. Speaking of which, we had our question of the week, which kind of wrapped up a lot earlier. We had to close it out earlier than we thought. We asked you guys our special earnings and election and World Series edition, and at the time back Monday when we posted this, Facebook Straddle was about 7:30. The VIX was around 1720. Seems like a lifetime ago. Which outcome, we asked you, was the most likely? VIX popping over 20 before the election, Facebook beating the at-the-money straddle, Donald Trump winning the election, or the Cubs winning the World Series. We had to shut this poll down early, Mr. Rhodes, because 3 of those things happened by like Wednesday. The VIX was already well over 20 by Wednesday. The Cubs had won the World Series that night, and indeed Facebook did beat their straddle. So it kind of made the poll kind of moot. But still interesting. Our listeners were savvy. They jumped right away and all said VIX over 20, which we all thought was a little bit a bridge perhaps too far. And then sure enough, lo and behold, it did pass 20 right away. Let's get to a real question, though. Really quickly, this kind of mentions, this is what I alluded to before. This one came in this morning from J-Vao. Hope I'm pronouncing that correctly, whatever that handle is. He says, am I seeing this right? Is the VIX cash printing above the futures right now? Kind of alluded to that earlier at the top of the show. Why don't you really quickly, Mr. Rhodes, walk our friend, Mr. J-Vao, through the nuances of the term structure versus the cash and all the fun they're in.
I never muted myself, so here I am. The difference between the term structure, there's just a little bit of a risk premium that goes along with any time you are shorting volatility. There's a risk premium because you can get you can get a very quick spike in volatility whenever whenever you don't expect it. So there's a little extra risk premium. So when we've got a low VIX, you tend to see the futures at a little bit of a premium. And the closer we get to expiration, the less that premium is. Now, right now, we're in an inverted term structure because VIX is up so much, and there is an expectation that it's going to come back down after the election. Time will tell with that one. But, that's the kind of the very high level gist of the difference between what the VIX futures are doing and what spot VIX is doing. They do converge at expiration, and if you think VIX is going to stay right where it is, often shorting some sort of volatility derivative is actually a way to go, because that risk premium is going to dissipate as we get closer to expiration.
Yeah, people are just so used to reflexively seeing that premium in the futures versus the cash that when it gets a little inverted like this, they don't know what to do with themselves. they're just, wait a minute, I didn't think this was possible.
Hold on a second.
Yeah, this something's broken. The VIX is wrong. So yeah, this does happen. They are tradable products to futures, and all they're showing you is just what the future outlook for volatility is. The cash, as we said before, a different beast, and there's going to be discrepancies between those two. It's not always a premium. Usually there's a premium, but it's not always the case, as we're seeing right now. All right, we got to keep on rolling into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball, a.k.a. the embarrassment block for the week. We had a challenge last week because, of course, the VIX was just raging as we were trying to guess for the week ahead. It was right around, I believe, the 17.5 or so level when we were prognosticating at the end of the show, and it was myself, Greasy Meatball, the Rock Lobster, and Bill Luby. So we had quite the assemblage of people all guessing. Bill was fading the VIX. He was leaning the way I was. I was leaning on 15.5. Bill came in 15.43 for an oddly precise bit of prognostication. So he scooped me to the downside. So I had to go a little bit higher. I said 16. Still, obviously, dramatically underestimating all things volatility to the upside this week. And of course, our friends at the pit splitting the difference for the two of them, 17.15 for one, 17.50 for the other, 17.5, which was pretty much exactly where we were. So Andrew was betting on no change for the week. So all of us obviously dramatically underperforming to the downside this time. So I'm not comfortable, even though I guess net point wise, Andrew was the winner. When we're nearly 4 handles off. I don't know if anyone's really the winner in this scenario. So you picked a good week to take off, Mr. Rhodes, because nothing but embarrassment would have ensued, which is always fun for the listeners. They get to write in and shame us appropriately. But that said, Mr. Rhodes, you were off last week, so I'll give you pride of place as we're closing out the show here right around 21:30 in the VIX cash. So what are you feeling this time? Of course, next week will be post-election. The futures are certainly pricing in a sell-off, but you've been buying VIX all year. So what are you feeling?
What am I feeling? Golly, man, this is the toughest one ever, don't you think?
It is pretty challenging for a lot of the reasons we just illuminated.
I'm going with 23.50. I don't think
you're still buying.
I don't think we're going to know who the president of the United States is this time next week.
You're going for a 2000 era election scenario, huh?
I know. I really, and this is also my big fear, but I'll put this on hold for a second, but I'll come back to this when we talk about what we're doing next week.
You said 23.50. That's what you said.
I said 23.50, and then I'll let you guess, and then I'll expand on what we're going to be doing around here for the election.
And the ghost of the Greasy Meatball, he could not make it today. Caught up in the madness of Grant Park, choosing the Cubbies over us, I think. So the ghost of the Greasy Meatball is going to go high. He's going to go 45 today. He's feeling the love.
No, he's going to do 1080 because it was 108 years.
That's what you want to do. All right, fine. I'll let you do some. I was thinking fade him to the upside. If you want to go downside, I'll allow it. Why not? Even though it's my show. All right, so I'll go give you 1080 makes you get so animated about this stuff. All right, and I've been feeling right around, I don't know, feeling my bones right around 18.5. I believe that is right where the front month future is trading right now as well. So I'm not feeling the upside level because I don't pretend to put on the tinfoil hat as often as you do. Where I think you've been reading Zero Hedge too much. We're not going to know who our president is next week. But if that indeed does come to pass, then my 18.5 level will look comedic and quaint in retrospect. But we shall see how this plays out. Listeners, as we move forward. Unfortunately, we're not going to move forward with any more show. That is about it for us today. There's that music we were waiting for. But before we go, as always, Mr. Rhodes, you alluded to some cool things cooking. What's cooking over there in the Institute as well as with our friends at LiveVol? You said they're really working up a lot of cool stuff over there. What's coming down the pike from them as well, sir?
Well, I think something soon is happening soon because the LiveVol folks from here went out to San Francisco. Which means we're close, and we'll probably have something to talk about in the next week or two. As far as here goes, we are, and I will not know exactly what the plans are until next Monday, but our social media team is probably going to spend the night at the exchange on Tuesday night and be available, to watch, because the VIX futures are going to be open for trading. And VIX starts trading, VIX starts getting quoted at 2:15 in the morning. So we're going to keep a close eye on the financial markets as the results roll in. And then finally, next week, we are doing the first ever Financial Management Association / CBOE conference on derivatives and volatility. It is only $95 for a day and a half conference, which basically covers your costs. It's very academic in nature, but if you have some questions about it, feel free to shoot me an email. I can still sneak a couple of people in.
There you go. Hit them up over there, listeners, if you are so inclined. So 24 hours of SIBO social media during the election. We'll stay tuned for that. Should be interesting. You going to be tweeting any of those tweets, Mr. Rhodes?
I'll be live tweeting a CBOE, but I will be doing it.
All right, so maybe some of those tweets coming out will be from Mr. Corner Office. And, of course, they have a cool update coming down the pike, so hopefully we'll get to see that soon. Maybe talk to them, see what it is. In the meantime, kick the tires for yourself. 15 days free. I think, actually, maybe even more. Their free trial over there at livevol.com. Kick the tires for yourself. Don't take our word for it, even though we use it throughout the show and really couldn't do the show without it. If that's not enough for you, head on over at livevol.com. Kick the tires for yourself, completely free. You got nothing to lose. And, of course, the Greasy Meatball couldn't be here. Check them out over there, optionpit.com, if you are so inclined. And on behalf of Mr. Rhodes and our guest, I want to thank David Hait for joining us from OptionMetrics as well, optionmetrics.com to learn more, and, of course, to register for the upcoming conference on November 14th. And, indeed, from myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And we'll see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE LiveVol. CBOE LiveVol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE LiveVol offers a broad spectrum of advanced trading technology, including the LiveVol X, next generation execution platform, and LiveVol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/VIX The Options Insider or via questions@theoptionsinsider.com.